This is Strictly Business, presented by the Greater Bakersfield Chamber of Commerce. Sponsored in part by the law offices of Young Wooldridge, San Joaquin Community Hospital.
And welcome back to Strictly Business. I'm Nathan Ollie, Manager of Government Affairs at the Greater Bakersfield Chamber of Commerce. Preparing for retirement is important, but there may be some hidden pitfalls that you may not be aware of. And joining us now to explain what to watch out for is Anna Colitti. She's the Private Wealth Advisor. That's a great Private Wealth Advisor. That's a great title. With Lincoln Financial Advisors Corporation. Thank you for being here.
No problem. My pleasure.
So for many people, the only exposure they get to retirement planning or financial planning is whatever the employer does. It's the 401ks, the 403bs. What are some things that people do with their retirement accounts that they might want to reconsider?
Yeah, that's a good question. You're right. A lot of people, the most they get exposure to in the retirement arena is their employer plan. So there are a few things that you want to look out for. Probably the number one thing is contributing to your employer account the bare minimum that the employer requires. So, for example, this is how it usually works. If I'm the employee and you're the employer will require a certain contribution to your account before they start putting money into your account as well.
Okay.
So you might require I put in 3%, and if I put 3% in, you'll start dumping money into my account as well. So the tendency is to just do that bare 3% on my end so that I get free money,
Right.
which is great. But rarely does 3% get you where you need to be in retirement. So we usually suggest at least 10% contribution rate, and that's for people that are starting off a little earlier, so at least 10%. The second thing you want to think about is when you leave your employer, if you leave your employer, you do have more options in taking your money and maybe spending it. But if you're younger than 59 and a half, that could be very dangerous because the government wants to incentivize you to save for retirement, right? So they penalize you if you pull it out before you're 59 and a half. If you pull money out before you're 59 and a half and you spend it, you have to pay taxes plus an additional 10% penalty tax.
Oh, wow.
So it ends up hurting a lot.
Sure.
And the third thing I'd probably mention is I encounter people that develop an emotional relationship with their retirement account. And that's understandable because you're putting this money away for retirement, for your future. You want to make sure that it's there. But something that I would encourage people to think about is understand that the market has volatility. And you're probably going to see ups and downs in your retirement account. And understand that that's short-term fluctuations. You want to take a long-term view of your retirement account.
Okay. So you mentioned contributions to the employer or to the 401k program offered through your employer, and 10%, I guess, was the guideline. What are some of the tax implications of that? Doesn't it actually decrease your taxable income? How does that work?
Right. So the money that you put into that account is not considered income. It reduces your income for the year. So if you put in enough, it might bump you into a lower tax bracket, and overall you pay less taxes. Not to mention the money that you put into that account isn't taxed. So if you put $50 into the account, you don't feel a $50 reduction in your paycheck that month or pay period.
Okay. I know that a lot of people... Go ahead.
Sorry.
I know that a lot of people have, concerns about that. Well, it's just I can't afford to do it. But in reality, what you're saying is you can't afford not to. Okay.
Exactly.
So what about some of the small business owners who are, their own employers, or they may have one or two staff people, and it's hard for them to offer a program like this? What would you suggest?
Right. So with small business owners, they're so busy. They have a million things competing for their attention, and it's hard to set aside some time and say, I'm going to devote this to setting up a retirement plan. And it's very convoluted or complicated to understand what type of plan I should implement, that sort of thing. So the only thing the one message I would give small business owners, it's a lot easier and a lot more cost efficient to set up a small business plan than you probably think. So as an example, I set up my small business retirement plan in a couple of hours, and it didn't cost me a cent. So I don't want to go into the details, but whether it's a SEP IRA, a simple IRA, an individual 401k, there's a lot of options for small business owners, and it would take just a small investment of time to set it up.
And I would imagine that would have other benefits as well, wouldn't it? With employees or potential employees that are looking for a new employer, looking for a place to come and work, they're going to be looking for companies that offer things like retirement and matching and things like that, right?
It's a really nice benefit, yeah. The employees really appreciate that.
Okay. I also think that a lot of people are heeding the warnings that they should protect their loved ones against premature death, and they go out and they buy life insurance. Any pitfalls in the life insurance arena that we need to look out for?
I don't know about pitfalls, but it's great that people are starting to purchase life insurance more. The word is getting out. People understand that's important, and they're doing something about it, which is great. What I've noticed is that people tend to look at life insurance as a yes or no question. Do I have life insurance? Yes, I do. Okay, that issue is covered. But really, it might not be. So you want to look at life insurance as a quantitative and qualitative question. So you want to know, do I have enough life insurance? So will my death benefit cover all of the financial needs of my beneficiaries and dependents? And then secondly, you want to make sure that you have the right type of life insurance. There's a lot of different types of life insurance, and they're not all applicable to your individual financial situation.
Okay.
So look into that side of it as well.
So what are some of the different types? I know there's term life insurance, and what are those types of things mean?
Yeah, so the big categories are term and permanent. So under permanent, it's kind of an umbrella, so it has a lot of different types of policies like universal life, whole life. You've probably heard of some of that. That lasts for a very long period of time. So a larger percentage of people actually receive the death benefits from the permanent policies. Versus term, it lasts for a specific period of time. It's temporary. So it could be 10-year term, 20, 30-year term. After those 30 years are up, that policy is no longer there. So you no longer are able to accept the death benefit if you passed away after the 30 years. There are pros and cons to both. Generally, term life is less expensive. So what you kind of want to do is look at your temporary costs, kids' college, mortgage, debt, that sort of thing that will disappear after a while. That is more geared towards term insurance, whereas permanent insurance might be for funeral costs, maybe if you want to supplement retirement income for a loved one.
Okay. And how would you recommend determining how much life insurance is you have a mortgage, you have a kid. How do you determine what is there some kind of formula, some kind of worksheets? How do you go about?
Yeah. So,
ask a professional?
Well, maybe.
Okay.
A lot of people say a multiple of your income. But if you want to get a more precise number, and this might be a little morbid, I'm sorry, but imagine yourself outside of the picture, outside of your financial situation, and look at all of your financial dependents. What will they need if you were gone? Would your kids need college expenses paid for? Add that to the list, or add that to the amount that you'll need in death benefit. Do you have debt? Add up all of your debt, add that to the death benefit. If you want some sort of supplemental income for your family, how much would you need? There are calculations where you can get a death benefit from that. So maybe the best option is to talk to a financial professional about it.
Okay.
But yeah.
Okay. And then on the retirement issue, obviously it's never too early to start. But let's say you're 40, 45 and you haven't started. Are you in a position then where you have to take higher amounts of risk in order to kind of make up? How does that work?
Maybe not higher amounts of risk, but you might want to contribute a lot more to your retirement account. We don't ever want to say it's too late to start, and 45 is definitely not too late to start. As long as you have the means, the resources to contribute to a retirement account or save in whatever manner you want to save, start doing it. Even if it's $50 a month, it really pays off in the long run.
Okay. So we can't just rely on Social Security. But speaking of Social Security, is there anything that we don't know about Social Security? I know for people that are our generation, the saying is Social Security going to be around when we retire?
Yeah, so definitely that's the talk amongst our generation. And I think that's the incentive or motivation for our generation to save for retirement, because they don't put as much faith into Social Security. But that's actually a little more controversial than I think I'm ready for.
Sure.
But Social Security is a science. There are people that have devoted their entire careers to understanding and educating people about Social Security. So it's not as simple as I want to retire at 65. I'm going to start pulling benefits at 65. I mean, if you're working and you start pulling benefits, you could reduce your benefits that way. If you are making a certain level of income in retirement, your taxes or a lot of your benefits will be taxed.
Oh, I see.
So there's things you want to consider, and there's a real strategy to choosing your life insurance benefit, how and when you start pulling those benefits.
Okay. And this last question sounds a little counterintuitive, but I'm going to ask anyway. Is there ever a time when depositing money in a retirement account is a bad thing?
Yeah, so as a retirement advisor, I never really want to say that it's a bad thing, but maybe not the highest priority.
Okay.
So, for example, someone that doesn't have anything in a savings account, you might want to stock away 6 months worth of expenses in an emergency fund dedicated to those short-term emergencies before you start putting money into a retirement account.
So things like, the water heater goes out, the tires go bad, things like that. So 6 months savings. Okay, and then where do you go from there?
And then you can start contributing to a retirement account. It goes back to what we were mentioning earlier about that huge penalty you take with retirement accounts. If you pull it out early for the short term, they'll penalize you heavily, and it ends up hurting a lot. So if you do need some cash, and most people do need cash in the short term, cover those short term needs first and then look at the long term.
Now, what about, so pulling maybe from a 401k or something like that for a down payment on a home? That's one of those things that got to be a little careful about with the penalties and things like that.
Some employer accounts allow loans, so you might want to look at something like that instead, where you can take a loan out on your retirement account, pay a lot of the interest or all of the interest back into your own account, so you're kind of paying yourself. That way you don't take penalties, but you still get the money for a down payment, and you're not paying somebody else, you're paying yourself.
Okay, and the interest then would be lower than maybe a bank or something like that?
Well, definitely credit cards, but
sure.
But it depends. It depends on the employer.
Okay, so just in closing, if you're looking to get started, the best thing to do is to just go and find an advisor and start talking about your personal situation and talk about where you want to get. That's the goal.
Yeah, so you probably want to talk to an advisor at least once a year.
Okay.
So if you're reviewing everything extensively once a year, you're on track, you're doing a good job. If you're doing any more than that, maybe you're getting a little too emotionally involved in stuff. If you're doing less than that, maybe we need to put more attention on the retirement end of things, long-term goals.
Okay. It's interesting to hear you talk about the emotional attachment to the retirement account. I could see where it's one of those things where you get it's like you're watching the stock market every day to see how's my mutual fund doing, and then you kind of get caught up in the peaks and valleys. So taking that long-term view is the key. Huh? Okay.
Definitely.
So Anna Colitti, private wealth advisor from Lincoln Financial Advisors Corporation. Thank you so much for coming in today, Anna. We really appreciate it. All right, we're going to take one more break, and we'll come back with more Strictly Business and the closing bell. Stay with us.